Have you ever wondered how businesses raise financial capital? Today we're diving deep into the world of financial capital and exploring the various methods companies use to secure funding. First things first, what exactly is financial capital? Financial capital refers to the funds that companies use to invest in their businesses. These funds are used to acquire machinery, buildings, materials, and other resources necessary for production and service delivery. In simple terms, financial capital is essential for running a successful business and generating income. Now that we know what financial capital is, let's talk about how it works. The two most common types of financial capital are debt financing and equity financing. Businesses use these methods to raise capital and fuel their growth. However, there are also other sources, such as personal savings, grants, and revenue, that can provide capital for businesses. Let's start with debt financing. Contrary to what some may believe, starting a business with debt is not necessarily a bad idea. Debt financing involves borrowing money from a lender or a bank, which must be repaid in the future. Companies raise capital by selling debt instruments like loans and bonds to individuals or investors, in exchange for credit. Lenders typically expect monthly payments based on short-term or long-term repayment plans. To illustrate this, let's say you want to start a crochet business, but you don't have enough funds to buy all the resources you need. In this case, you could go to a bank or someone you know who can lend you the exact amount you need, with the agreement that you must pay a certain percentage every month. For example, you borrow $1,000 from the bank or an individual investor with a 5% interest rate. That's debt financing. So, every month, you're liable to remit an interest rate of 5%, which amounts to $50. There are different types of debt financing, including bank loans, bond issues, credit cards, and borrowing from family and friends. Bank loans are often harder to secure for small and mid-tier businesses, and they usually require collateral. Bond issues involve selling bond certificates to creditors, while credit cards are commonly used by small businesses or startups. Borrowing from family and friends is a popular method, especially for small businesses and startups. Debt financing offers several advantages. First, it allows you to retain full ownership of your business without sharing it with investors. Additionally, you can benefit from tax deductions by deducting the financing costs from your taxable income. Debt financing also helps improve your business credit score and allows you to keep all the profits made in a financial year without sharing them. Lastly, it tends to be less stressful and complicated compared to equity financing. On the flip side, there are some disadvantages to debt financing. Relying solely on debt can be seen as a risk by investors, potentially harming your business credit in the long run. Repayment of interest rates is mandatory, regardless of whether your business is making profits or not. Furthermore, providing collateral in the form of properties or equipment puts them at risk of repossession if loan repayment falters. Now, let's move on to equity. Equity financing involves raising capital for your business by selling a portion of the company's equity in shares. Startups often rely on this type of financing to cover operational costs and fund production. Investors who purchase shares expect returns through dividends or an increase in share value. To give you an example, imagine our crochet business owner couldn't secure a loan but found an investor. The investor purchases 20% of the business shares, granting them a 20% ownership stake. The business owner gets the capital they need, and the investor becomes a part owner. If the business grows, the investor is entitled to a share of the profits. Equity financing can take different forms, such as crowdfunding, corporate financing investors, venture capital funding, and initial public offerings, IPOs. Crowdfunding involves public investors contributing to a business they believe in. Corporate financing investors provide funding to private businesses for strategic partnerships. Venture capital firms invest in businesses with high growth potential, while IPOs allow established companies to raise funds by offering shares to the public. Angel investors, on the other hand, bring not only funding but also expertise and connections to support the organization's long-term success. Equity financing offers several advantages as well. It is particularly beneficial for startups, as angel investors and venture capitalists bring skills, experience, connections, and advice to the table. Unlike debt financing, there is no repayment of initial investments, and investors are more likely to support your success due to the potential financial rewards. However, there are also some drawbacks to equity financing. Selling a percentage of ownership rights means shared ownership, and your decision-making power may decrease as investors have a say in certain decisions. Equity financing is generally considered more expensive than debt financing due to the higher rate of return demanded by investors. Additionally, companies are obligated to share their profits with investors. Apart from debt and equity financing, there are other sources of financial capital. Personal savings, where small business owners save up to fund their ventures. Grants awarded by charitable organizations or the government for specific purposes, and using revenue generated from sales to expand the business are all viable options. And there you have it, a comprehensive look at how businesses raise financial capital. Whether it's through debt financing, equity financing, personal savings, grants, or revenue, each method has its pros and cons. So, if you're thinking about starting a business or looking to grow your existing one, consider the various options available to secure the financial capital you need. For more details on this topic, read our article on www.prelax.com. If you found this information helpful, make sure to like this video, subscribe to our channel for valuable content, and hit that notification bell to stay updated. Until next time, stay prelaxed.